Greetings to you all. Welcome to DRN School of Entrepreneurship. I'm Jonathan Mlenga, your facilitator today, in a session which sets the stage for a comprehensive overview, or rather understanding, of financial management, accounting principles, and budgeting techniques, which have been tailored for entrepreneurs and business officials. So now, the main actual objective of this session is to empower you with the foundation concepts in finance, accounting, and budgeting. And I hope at the end of the session, we'll be able to have an idea or a basic understanding of how to manage your finances in order to maximize its value, and also be able to track and interpret financial data, and also be able to plan and control the financial resources which you have at hand. So let's start with the introduction of finance, the management of money, investments, and financial instruments. The aim is to achieve what? Organizational and personal goals. So take note of the key theme here: management. Management is key. In our daily lives, if you mismanage your relationship, you lose it. You mismanage what you have at hand, you lose it. Even God Himself, He gives you what you can manage. You may pray for a 5-bedroom house or a 5-star hotel, but if you look at where you're coming from, in a 2-bedroom, you're trying to manage it. God won't give you that. So you'd find that you may pray for something big, but God sees deep down how good at you in terms of managing. So He can only give you what you can manage. So let's look at types of finance. Personal finance, managing individual or household finance. There is what we call the 50 to 30 to 20 rule. 50 means you allocate your finances, whatever you have, allocate 50% to what? To your personal needs. 30%, what do you want? That's why entertainment comes in. 20% it goes to what? Savings. So that's what we call personal finance. There's corporate finance. Corporate finance, you look at what? The financial decisions which you make within a business entity. That's why investments comes in. The funding, how do I raise funds for my business? How do I raise funds for a certain project? So when I'm making such strategic decisions, you're dealing with what? Corporate finance. There's public finance. Public finance is government revenue and expenditure. That's includes what? Taxation, public budget. So if you're in a position as a policy maker or a policy decision maker, you make such strategic planning through what? Public finance. So these are the key types of finance which you need to know and understand as an entrepreneur or as a business professional. We need to also look at a subset of finance. What is it? It's financial management. Financial management is more of what? A strategic planning and control, where you tend to make decisions, critical decisions. Why do you make such decisions? Because you want to optimize what? Financial resources. It could be for an individual, or for a business, or even for a government, based on your position, your current state. Now, what is the main goal of financial management? Is to, of course, maximize what? Profit. That's a short-term goal. On a long-term perspective, wealth maximization is key. You want to do what? To increase the wealth of the what? The shareholder. So that's basically the main goal of financial management. Now, what are some of the key financial decisions which you tend to make? There's investment decisions. When it comes to investment decisions, you need to decide how best can you allocate what? Your resources which you have at hand. What kind of project do you need in terms of investments? What do you need to buy? What kind of machinery? Some of those questions, they're in line with what? Investment decisions. Let's look at financial decisions. Financing decisions focuses on what? The capital structure. You determine whether do you need debt or is it equity. You may be a CEO or a founder of a startup company. So you reach a point where you tend to decide, how do I raise funding? Do I sell my shares or do I just get a loan? So when I'm making such strategic decisions, you need to be extra careful. Then you're applying the principle of what? Financing decision. There's also dividend decisions. You reach a point where you've made profit for the company. Now you want to allocate the dividends to what? Your shareholders, or you want to reinvest. So as a CEO, as the CFO, you need to make strategic decisions to know when to decide whether the profit has to go to the shareholders or we need to reinvest in order to think about the future growth of the company. What are we looking at now? We're looking at the combination of both. I said finance, or rather financial management relies on finance. So these two, they are more interlinked. In what form? Finance examines how banks work. That's an example I'm giving. If you're trying to examine how do banks work, how does the stock exchange work? How do these regulators operate? Then you're applying what? The principle of finance. But when you decide on how to engage with these entities, if you want to get a loan, if you want to issue a bond, so that form of decision which you're making, which means you're applying the what? The financial management strategy. So that's how they are interlinked. So in short, finance, you develop an understanding of the systems and the instruments which are used. When you talk about the financial management, you're trying to say how best can you optimize your resources used to achieve a certain goal. Now, who uses such principles or rather strategies? As an economist in your position, you definitely focus much on the finance aspect because you tend to understand the economic models, the statistical analysis, and in this case, of course, we're using now AI to determine how are the trends happening, how do I know the current state of the sector, where I need to invest, what do I need to do, which instruments should I use, how's the bank, coming up with the interest rates. So in that case, you definitely use the financing principle strategy. Now, when it comes to you as a CEO, as a founder, as an accountant or a manager or an entrepreneur, in most cases, you lean towards financial management because you're always in a position where you have to make strategic decisions that will support or rather guide the future of your business. You, in most cases, deal with budgets that have been presented on your table, the ratio analysis, the cash flow statements. All those are some of the tools which you use to make the financial decisions that will help you optimize the resource to meet or achieve the target goals which you've set. Now, there's this case study where you're the CEO and you want to hire a CFO for your business. Which one would you hire? There's the networker. He's great at raising funds and impressing investors, but is not based at managing costs. B, there's the operator who's excellent at budgeting and keeping cash flow steady, but is not strong at bringing in new capital. So you can pause a bit and see which answer you would give. So in my opinion, every response depends on what? It depends on the current risk profile of your business and your growth stage as a company. So what do I mean? You need to analyze which risk is minimal to your personal decisions. Here's a practical example. If, let's say, I'm a CEO for a startup company, definitely I would lean towards the networker. Why? Because I need source of funding to expand my business to grow fast. Now, at a certain stage, definitely I would need someone to manage my costs. So am I willing to risk the ignorance of my CFO to manage costs to him bringing in funding for the company because I want to grow? Those are some of the key questions you need to ask yourself. Then the operator, he's excellent at budgeting and keeping cash flow steady, but not as strong at bringing in what? New capital. So still, I'm a startup company. So I'll be like, no, this guy, He's not good at managing costs. Let me go for the operator because this guy is good at budgeting, keeping cash flow intact, and definitely I can hang in there. But the question is, at what point do I able to grow my company? Because I'm operating my company based on the capital which I have, which I've pumped in as a shareholder. So if I don't have the capacity to pump in more funds to expand my business, which means it will drag at a certain constant stage where I don't grow. But if I know that my target is to raise funding, I'll definitely go for the networker who is key at raising funds. Now, if you're already an established company, a big, you definitely don't need someone who's a networker because you've got the financial capacity to run your business and grow at a certain stage. So you need someone who's able to keep books and is able to keep and monitor the cash flow stages. So those are key stages which you need to decide yourself based on your current state and see that this risk, you can manage it, it's minimum. But this risk, I can't. So that's just my opinion. Let's move forward now. What is accounting? We need to actually understand what accounting fundamentals are. So let's start by defining it. It's a systematic recording, reporting, and analysis of what financial transactions to provide insights into financial health of what could be a business or of an individual. Accounting can apply anywhere. You also need to know the types of accounting that exist. There are quite a good number of them, but the key ones are what? The financial accounting. This one, it requires you to prepare what you call the financial statements for either external stakeholders, I mean investors and regulators. So regulators would look at government institutions that regulate how your business operates so that you're compliant. There's management accounting. This one provides internal reports for decision making. So you have certain reports that are presented on your desk as a CEO. You need to make certain strategic decisions based on the reports that you've been given. You can also easily analyze, let's say cost analysis is one of the examples when it comes to decision making. Now, there's also cost accounting where you track production costs to optimize efficiency. That's another type of accounting. Now, there are also these principles that exist in accounting. There's accrual principle. This one basically records your revenue or expenses when earned or incurred, not when cash is exchanged. What do I mean? For example, if today you sold a good worth 3,000 kwacha, but you haven't been given that payment, so you sold it, let's say, in January, and then maybe in February and August, that's when you are paid. You don't record when you are paid cash. You record that very time when you sold your good. That's what it means. That's the principle of accrual. Now, when you talk of matching principles, you match expenses to related revenues in the same period. So in this case, the moment you make an expense towards what you have gained, you record, you make some sort of double entry in the same period so that you're able to keep track. Not while you wait, you make an expense today, then you wait for a certain period of time and then you record. No, what you mean is, where has the expense gone? It went to this, which you did, so you match them, you link them. That's what it means as a matching principle. Consistency is key. You need to pick which accounting principle you're using so you align with it, you follow it. You don't use one principle today, 2 months, 3 months, or next day use a different one. It will confuse you at a certain stage. So if you pick one principle, you've seen that this one works with you, you become consistent in it, it helps you to track your records and be able to have the proper records which are needed. Now, the going concern basically means you know for sure that your business will outlive you. So if there's a cost that you've made, you need to know that this cost, you can drag it over a period of time. So what I mean is I'm considering depreciation. So if you were to secure a certain equipment, so you drag it, let's say for 5 years, that's why you spread the cost of the depreciation will run for like 5 years, So that's what I meant by the going concern. Let's now look at another principle which is key, the double entry system. This one is one of the key principles which you need to learn in accounting, as in fundamental accounting. So it's a system where every transaction affects at least two accounts. These two accounts are what? The debit account and the credit account. Now, in the debit account, it's basically an entry on the left side of the account. So there are two sides, the left and the right. So from the left side, there's a debit. From the right, it's the credit. So you need to take note of which accounts increases on the debit side. So there are assets, there are expenses, there are losses. When I talk of the loss, I'm talking about that you may have maybe the lawsuits, expense or the fire damage, those are losses. Now, other accounts decrease when you're recording them on the debit side. Those are liabilities, something which you owe to someone. Equity and the income or revenue, all these are key recordings that you need to take note of that decreases. Let me give you an example. If you're buying an equipment for cash, on the debit side, the equipment, which is an asset, increases in value because you're receiving an asset. But on the credit side, you record cash, which is an asset, it's a current asset. You record the decrease because it decreases. So it's the same. Let's say you've got an account, when you remove cash, you buy an equipment, let's say a vehicle worth 5,000. So from the cash, you've removed the 5,000. That's why I'm indicating decrease in size. And then from the equipment you've gained, the vehicle which you bought, which is valued at 5,000. So you record the debit on the asset side, which is the equipment, it increases. Now, on the credit side, it's of course an entry on the right side of an account. So you need to take note of what increases from the credit side. Liabilities increase. Remember, from the debit side, liabilities do what? They decrease, but from the credit side, they increase. Equity also increases. Income and revenue, they increase. So take note of how they switch. What decreases on the credit side is the assets. Assets, they decrease. Expenses, they also decrease, and losses. Here's a practical example. If you receive a loan from the bank, from the debit side, of course, cash is a current asset. It what increases? Your account, your cash account, you receive funds, of course, so the value of what you have in the account decreases, right? That's what it means. From the credit bank loan account, it's what? It's a liability. At some point, you have to pay that back. You get, so as much as it increases, so that liability increases, you have to pay it back at a certain later stage. So one of the memory tricks which you need to master is what? Debt. It means debit increases expenses, assets, and drawings. The click credit increases liabilities, income, and capital. So you need to spend more time on understanding how they're a bit confusing if you're encountering such a topic for the first time, but with time, when you master them, you're able to grasp what they all mean or how they interchange in terms of recording. So let's move to the next slide, which talks about what the financial statements. From my previous slide, remember I was talking about assets. I wasn't even explaining what they mean. But in this second segment, financial statements, we're going to learn by assets, liabilities, equity, and all that. So financial statements are key. As a business, as an individual somehow, financial statements, when I mean as an individual, it means you're a CEO, you're running a business, or you're a founder, or you're an entrepreneur, you need to have an understanding of what financial statements are about. Formal records of the financial activities and positions of a business, for a person or an organization. What do they do, these financial statements? They summarize financial performance over a certain period of time. It could be a quarterly or annual. That's what they do. What do they consist of? They consist of what? Standard reports used for accounting, auditing, and decision-making. That's why I mentioned these are key. You need to know and have an idea of what they're about, because you have to use them at a certain stage. Now, who uses such financial information? Remember, I mentioned to say you as a director, you are in a position to know what financial statements are about, because you'll be forced to make a strategic decision at a certain stage once you analyze the performance of your company, whether it's good or not. Then there are all external stakeholders. Those are what investors. For an investor to invest in your business, they will ask for financial statements. They'll look at the profitability of your company. How good are you in terms of keeping track records? How is your business doing? What's the value of your company? All those questions. Answers are in the financial statements. Creditors, they look at the creditworthiness of your business. If you want a loan, you go to the bank. They'll analyze your bank statements or rather financial statements to see how you've been performing. If they're able to give you a loan, if you're going to ask for one. Regulators, compliance. Compliance is key based on the financial statement. So they will see how you've been running, whether you're dodging off the tax. So financial statements are key. Now, let's move forward to the next slide. Now, we're looking at the types of financial statements. There are three key. Okay, there are, in most cases, there are like four, but the key ones are three of them. The balance sheet is one of the first financial statements which you need to understand. So it's more of what? A snapshot of assets, liabilities, and equity at a certain point in time. And the key thing you need to know about the balance sheet is just the equation, which is assets is equal to liabilities plus equity. Now, what are assets? Assets are what you own as a company. What is it that belongs to you? You can break them down into current assets. Cash is current asset, but the key thing you need to know is inventories that can be converted into cash within a year. They are all current assets. Anything that you have, which you can't easily convert within a year, for example, properties, vehicles, and those are fixed assets and they are non-current assets. So the key thing you need to take note of is what? Cash, of course, is a current asset, and what defines a current asset is that within a year, you're able to convert it into cash. Okay. Now, let's look at liabilities. Something which you owe, which you have to pay back at a certain stage. So current liabilities, the same, anything within 1 year which you're supposed to pay back. There's a short-term loan which you have, and you have to pay it in 6 months or 8 months. That's the current liability. Non-current liabilities, those long-term loans which you've gotten, even a bond which is supposed to pay at a certain stage. Those are what? Non-current liabilities. There is also equity. Equity is basically what owner's interest in the business. Share capital, money which you have invested as a owner or as a shareholder. Those are types of equity which you're talking about. Retained earnings, what you have accumulated, the form of profits, and you're yet to distribute as dividends to shareholders. Those are retaining, and of course reserves. So you'd find that when you break these down, assets should be equal to liabilities plus equity. That's what the balance sheet is all about. Let's move to the next one, which is what? Income statements. It's called profit and loss. What does it show? Revenues, expenses, and profits over a period of time. This is very important because it shows what? The revenue, the sales which you've made. You've sold goods or you've offered a service, you record that. Once you record that, you understand that there's a cost to what you've sold or the service which you've offered. It's called the cost of goods sold. For example, the materials and labor and production expenses. Those are cost of goods. Why are they? Because they are directly linked to the production of the goods and services which you've sold or the services you've offered. So the direct cost of producing goods or services is called the cost of goods, and that is key. From there, now I need to understand, okay, here's the cost of goods which I've produced and I've sold at so much price. Let me find the gross profit. You get the difference from the revenue to the cost of goods and products, or rather service which you've sold. The profit which it shows, it's before what? Other expenses. Other expenses are what? The operating expenses, which are indirect cost of running a business. So from the gross profit which you found, you take note of other expenses, which are called operating expenses. That's why now the salaries come in, or wages, the rents, the utilities, the marketing, the administrative expenses, all those they fall under what? Operating expenses. From there, you take note of what? The operating profit. How do you calculate it? From the gross profit, you remove the operating expenses. From there now, you take note of what? The earnings before interest and tax. What is the interest which you need to pay from the money which you've borrowed if you got a loan at a later stage? Income tax owed to the government. How much do you owe to your government? When you remove such expenses, you then now calculate your what? Your net profit. Your net profit is your last, or rather your final profit after all the expenses have been removed. It indicates the actual earnings available to the shareholders. But take note, high revenue does not mean high profit. If you notice from the revenues, when we removed the cost of the goods produced, we had the gross profit. But from there, we didn't even incur what the expenses. So when we started considering the expenses, the tax, the interest, and all that, we reached what? The net profit. So what you need to understand is you need to analyze the margins to understand the cost efficiency. Of course, the consistency and the growth in the net income is key because it shows what? The financial health of your company. So you need to understand the structure of the income statement. Let's look at the third one, the cash flow statement. The cash flow statement tracks the cash in and out from any operations or rather investments which you're making and any financing which you're doing. It starts with operating activities which you need to take note of. So the cash which is coming in on a day-to-day basis, you need to take note of it. That includes the cash which you're receiving from your customers, the payments which you're making to your suppliers and employees, the interest and tax payments you're making. So it definitely, or rather, it indicates whether the company is generating cash or not to sustain itself. So from there, you can make a decision whether you need a loan or you don't need a loan, or can you invest into something else that can be determined on the cash flow statements. So when you talk of investing activities, like I've mentioned, you can buy or sell an asset. And the cash which comes in there, which goes out, you have to take note. That's an investment activity in equipments and in land and property. What else do we have to consider here? The cash flow statements helps us to assess how the business reinvests its profits or expands it. Have you reached a stage where you need to expand your business? You can determine that based on the cash flow statements. Financing activities, you can also reflect on how the company funds its operational expansion through the cash flow statements. So all these three financial statements are key and they are interlinked. What I mean is you cannot omit any of these. Even when you're building them, you would see that they flow in a chronological order. So these are the basic financial statements which you need to know and understand as an entrepreneur or as a business professional. So let's now move on to the next slide, which is what? Budgeting techniques and financial forecasting. A budget is a quantitative plan for allocating resources over a specific period of time. A budget can be broken down into different what types. One, operating budget. So your day-to-day revenue and expenses, for example, salaries, sales, all those are what? Operating budget expenses. When you talk of capital budgeting, you're looking at a long-term investment. If you invest into a property or a machinery, that's what? That's capital budgeting. There's cash budgeting. When you keep track of how cash is coming in or is coming out to avoid any liquidity issues, you're dealing with what? The cash budget. So every time you record how much cash has come in, how much has gone out, so that's what? The budgeting of cash. This master budget, this one, of course, consolidates all budgets into an integrated plan. So the master budget is key because it consolidates all. And in most cases, you need to know this one at any cost. What method exists? There is zero-based budgeting. This one justifies every expense from scratch. No reliance on what? Past budgets. Let me give you a simpler, practical example. If you went on a vacation last summer You got your suitcase. It was an empty suitcase. You packed things which you needed, all the items which you needed. So after packing those items, you went for a vacation, then you came back. This year, again, you plan to go for a vacation. The suitcase has to be empty. It starts from zero. You need an empty suitcase. You start again packing items new, one by one. When you pack them, then you go to your vacation. That's what zero budgeting means. In other ways, what I mean is, when you're creating a budget, you start from zero. So if you need, let's say you want to buy the materials for you're a bakery and you want to buy materials for baking, the cost of flour, let's say last year it was at 10,000. This year you want to say, oh, last year the cost of flour was at 10,000. This year you'll be like, no. Obviously, there's someone who's selling at a lesser cost. I heard someone was selling at a good one. You can give us at maybe 8,000. So you tend to analyze, oh no, today I'm going for this one, I want to go for this one. So there's nothing like, but last year we bought that so much. That's what zero-based budgeting. If you start from the scratch, you build it from the scratch. Then you go to incremental budgeting. So incremental budgeting, you adjust the previous budget by a certain percentage. It's simpler and it's less flexible. Let's go back to the suitcase again. Remember, from the zero-based budgeting, the suitcase was empty. You packed in your items. The next trip which you had, which is this year, you did the same. You got an empty suitcase, you packed. But when it comes to incremental budgeting, remember the item which you packed last year. You get that same suitcase. This time around, you don't remove everything, right? You remove one, you isolate certain items, you add what you need this time around, you remove this, you add what you need. You don't empty your suitcase to zero. That's what it means. So in a broader perspective, what I mean is, if you're a school, last year your budget was, let's say, 500,000. This year, you just add, let's say, a 5% increment to what you had last year, or you drop it by 5%. That's what I meant. You don't build it from the scratch. There are pros and cons for both of them. For example, the zero-based budgeting, it takes time. You have to analyze the current state, or rather the cost of what you need. But for incremental budgeting, you just adjust by a certain percentage, which means you may lose. If you're dealing with an incremental budgeting, right? You might even fund what is not necessary, certain projects that are not necessary, because you're dealing with the same budget, you're just increasing or reducing. But for the zero budgeting, the good part is you are omitting or removing an unnecessary project that didn't even materialize, so you're saving. That's a good part. And in most cases, incremental budgeting, government institutions are the ones that uses. For zero-based, normal companies would go for the zero-based budgeting. So the choice is basically yours on which one you'd go for. So that's all about the budgeting techniques and financial forecasting. Of course, there are these processes which you can easily review. For example, revenue forecasting, which estimates the future sales and income. There's cost estimation, where the project is fixed or variable costs, for example, materials and labor. And there's also the target setting, which defines the financial goals, for example, the profit margins and the cost reduction. At this stage, this is how far we can go with the fundamentals of financial management, accounting principles, and budgeting techniques, which have been tailored for you as an entrepreneur or as a business professional to have an idea or a concept. I'm sure by now you're able to give a perspective on how you can make strategic decisions for your business, for your entity, whether you need a loan or you don't need a loan. You need to be able to read the financial statements and know the accounting entry, the debit and credit. So I thank you for your attention. Hope to see you next time. Thank you very much.